Pathway to Success, the course aimed at building a thriving mindset and providing essential tools for achieving your goals in personal finance, presented by the professionals at KVR Team. This course is designed by a financial professional. However, it is meant to be used as an educational resource only. It includes vital information about very critical factors which can determine our level of failure or success in reaching financial goals. It also provides tools and strategies that can help you put money to work instead of always working for money. The following information is not intended to be considered as accounting, investment, tax, legal, or financial advice and should not be taken as such for any particular individual. Please consult with a licensed professional for specialized advice and to build your financial plan. Pathway to Success. Compound interest. The credit trap. Taxes. Inflation. Assets and liabilities. Infinite banking. Income streams. Compound interest. There is a formula that can play a huge role in helping you become financially independent if you know how to apply it. It's called the rule of 72. Take 72 and divide it by any interest rate. That will tell you how many years it will take for that original amount of money to double. Interest can be the money a person must pay back as a charge for being given a loan or money they receive from an investment. Compound interest is what banks use to make money from loans. They charge from 3% to as much as 20% or more. They give out much lower amounts of interest, typically 0.01%, for using our money that is in our savings and checking accounts we open. Compound interest works by putting interest on top of interest, which is on top of the original money. It can be added up on an annual, monthly, or even a daily basis. The more time you have, the more your money can grow or compound. On the other side of that, the longer the term of a loan is, the more you will end up paying. Here's an example of the power of compound interest. If you put aside just $20 per day or $600 per month in an account that gives you an 8% annual compound interest, you will have almost $210,000 in 15 years. If you can double the amount of time you save to 30 years, then you would have over $900,000, more than 4 times as much. This type of savings can be a significant addition to other retirement income sources. All it may take to save $10 or $20 per day is a simple change from some spending habits you may have now to saving habits. The credit trap. Credit cards and credit scores are a major contributor to excess consumerism in the US. The goal of credit card and credit score companies is to get people to overspend and then charge interest rates as high as legally possible. This keeps people in a cycle of never-ending debt. One way to handle credit cards is to have 1 or 2 of them at most, and if they are to be used, the whole balance should be paid off the next month to avoid interest and fees. There are promotional offers and incentives companies advertise to get people to use credit cards. If you use them and pay off the balance every month, like when you're using cash, you can take advantage of these offers. You can also benefit from the purchase protection that comes with a credit card instead of using your debit card or cash. People fall into the trap when they don't have the cash to buy things. Then put them on a credit card and make only the minimum payments. This is a non-stop cycle of debt that we can avoid by being careful of our spending and sticking to a plan even when there are things we want to buy right away. Here's a simple test to find out if you are spending more than you should. It's called the 5 rule. If you can buy 5 of what you want at one time without feeling a pinch, you are probably in a good enough financial position to get it. If not, it is a good idea to wait until you can pass this test to buy whatever it is you want. Using credit cards creates a profile and a credit rating. Your ability to pay on time or not shows up in these credit profile reports and affects your score. Credit ratings help banks decide how much interest to charge. People are then approved or denied credit based on that history and their spending habits. One of the major credit agencies in the US works with a scoring system of between 300 and 850, 300 being the worst and 850 being perfect. The vast majority of scores are between 600 and 750. This ensures companies get to charge higher interest rates to most people on any loan or credit line they apply for. Your credit score is important to the bank's efforts to maximize on the charges, interest, and fees they can hit you with. The lower the credit score, the higher the rates and fees. In order for credit scores to be as high as possible, people have to pay on time for every account, never miss any payments, and make sure that no inaccurate or negative information is on their report. According to the Federal Trade Commission, as reported by creditcards.com, 1 out of every 5 Americans has an error of some kind on their report. Many of those errors are severe enough to affect their credit score. People are then charged higher interest and fees because of this. When people cannot pay their bills and they have become overdue for a certain length of time, the debt is charged off. Then it may be sold to a collection agency for about 10% of the original debt. The collection agency then tries to get the original amount owed from people. This is how they make profit. In our view, a person should work with the original creditor before the debt is sold and pay only that creditor the debt owed. If a delinquent debt goes to a collection agency, your credit report will receive an even worse rating for that account. It will often show up on your report for years to come as unpaid or charged off, even if you pay it. Collection agencies also misidentify people on many occasions and may use questionable ways of collecting what they think you owe. We believe that if someone talks with a collection agency, it should be through an attorney or other party qualified to negotiate and resolve the debt on your behalf. It is a good idea to limit spending on things you want, but don't need to 5% of your income or $5 out of every $100. Have a budgeted allowance and use a separate debit card instead of cash to track what you buy each week. This can help you avoid more debt. Building a higher credit score through on-time payments and lower credit usage can put you in a position to increase your buying power. This lets you have a chance to take advantage of investments or other opportunities that cost less when the economy is down you might miss out on otherwise. You can then use the bank's money like they use ours to acquire things that produce income streams and methodically become financially independent. Next, we will discuss taxes. Benjamin Franklin is credited with saying, "Nothing can be said to be certain except death and taxes." Here, we will discuss 3 main tax categories and some financial accounts that utilize each of those categories. Taxed right away. This means any earnings from these accounts must pay tax for the year in which you got the money. Accounts that are taxed right away include checking accounts, saving accounts, CDs, stocks, and mutual funds. Taxed later on. You don't pay taxes now. The accounts that fall under this tax category include 401k, 403b, 457, and 529 accounts. IRAs and SEP IRAs, annuities and pensions. Tax advantaged. Tax advantage accounts are usually started with money you already paid taxes on. The gains. Money you make on top of your original money. In these type of accounts that can be completely tax-free upon withdrawal when set up the correct way include life insurance, a secret tool of those who are financially independent, and long-term care benefits. It should be a goal to have more of your money in tax-advantaged accounts. Most of us only have money in the first 2 buckets. By using a strategic order when accessing accounts that are affected by these types of tax categories during retirement, You can reduce your taxes and make your money go further. Talk with a licensed financial planner who knows how to do this to find out how it can make a difference for your retirement. Inflation. With our current system, a certain amount of money can buy more goods and services right now than it will be able to in the future. Inflation eats away at how much you can buy with your own money. It is called the hidden tax. According to USinflationcalculator.com, the national rate of inflation in 2023 was 3.4%. Inflation happens because more money is printed and put into circulation every year, lowering the value of the currency already being used. Any account you have your money in must give you at least the same amount of interest as the rate of inflation, or you are losing more and more of your buying power of your money every year. Assets and liabilities. To become financially independent, it is important to be able to tell the true difference between an asset and a liability. An asset puts money in your pocket. A liability takes money out of your pocket. Here is some information that may challenge how you view assets and liabilities. The American dream. How much ownership do we really have? For many people, a house is their single largest purchase. Most consider their home to be an asset. The biggest question to ask would be, is it your asset? The vast majority of people who buy a home are really only buying a loan, known as a mortgage. The house they will live in is something the bank could take back, foreclosure, making it a safer bet for the bank to give them the loan. The term mortgage means death pledge. It is a plan to have people making payments on a house for as long as possible. For many people, this ends up being much of their life. Houses that are purchased with a bank loan have what is called a lien on them. This means that until the home is paid off, whoever holds that lien must be paid before the home can be sold. Most American homeowners believe they have made a great investment buying a loan for a house they are paying all of the expenses on. This takes money out of your pocket, which we define as a liability. While owning a home may be a great source of personal satisfaction, those who are financially free make this type of debt work for them by finding other sources and/or people to pay the loan. This is known as leveraging. Leveraging uses loans or debt to buy properties or other investments that will create an income stream larger than the loan that has to be repaid. Our view is that a home is only an asset if someone else is paying the loan and expenses on it. In real estate, the goal should be to own properties that give you money every month when rented or shared, while increasing in market value at the same time. According to mortgagecalculator.org, banks began to push for marketing home ownership in America around 1949. This was just after World War II ended and the baby boomer generation began. Banks wanted to increase the number of loans they hold and the interest payments they would receive from those loans. The interest collected from millions of home loans gives the banks a huge cash stream for years before homeowners begin to see any reduction in what they owe. They called this marketing plan the American Dream to promote loans for so many who couldn't buy a house in cash. Houses were priced above what most Americans could pay unless they borrowed from a bank. As part of the Truth in Lending Act in 1968, banks must show exactly how much money they will make during the life of a loan. However, people still sign mortgage papers every day without fully understanding what they're getting into. For most loans, people end up paying 2 to 3 times the original price of the home. This is just one of the many ways banks have compound interest working for them. According to the National Association of Home Builders, the average duration of home ownership is only 11.4 years for first-time homebuyers. Most home loans are set at 30 years. People hope their home will gain value that outweighs the expenses they have been paying. This is called equity. Equity is the main reason people believe their home is an asset. Although houses may increase in value, this can take years, and they can also lose value, as we have seen. Additionally, how much a house is worth depends upon many factors outside of the homeowner's control, such as the surrounding neighborhood and the conditions of the nearby houses. A home equity loan can tap into a house's value. However, you must be extremely careful of what you're using this for. It is another debt trap, and our goal is to be free, not trapped further in debt. Instead of buying only one home, living there ourselves, and paying for everything out of our own pocket, we could do the following. Find an investment property with a cost that you can qualify for, in an area with the potential for increasing value and other indicators of a vibrant neighborhood. Find out the demand for rentals in that area to get an idea how quickly you could rent it. Your current housing cost should be 10 to 15% of what you make at most. If you can keep that to 10% or lower, that gives you a better chance of covering your own personal housing costs with income from the investment property. The idea is to rent the investment property for the same amount you pay for your own housing each month, plus the loan and utilities and expenses for that property, or as close as you can get to that amount. You have to be prepared to pay for the costs of the investment property along with your own dwelling if you have any delays in finding renters or if there are any gaps in occupancy. You can also buy a property that is designed for 2 families or more and make sure that the loan and all the expenses are paid by the family renting from you while you live in one of the other units. In these examples, we have reduced our own housing cost to near zero. As soon as we are in a financial position to do so, we repeat this process as many times as suitable for our goals. There are management companies that can help with the properties, and it is wise to put together a team of people to provide valuable information and services as the number of properties grows. Your team will work with each other and with you as you grow. The fees they charge can be paid from savings built up before an investment in a property is made, or from a portion of the rental income. In summary, the only way to make a house an asset for the buyer, in our view, is if someone else is paying the loan, property taxes, and maintenance costs. If so, then it is an asset that can work for you. Another personal finance strategy we can put to use is called infinite banking. This is a way to literally become your own bank, and it is based on the use of life insurance. It is similar to what banks do to create income streams. Again, the plan is to make money work for us instead of working for money. It is an investment design that everyone should consider making part of their plan. You can only find a combination like this with an insurance company. The types of accounts typically used for this strategy are indexed universal and whole life policies. Some of the advantages of the infinite banking or cash value strategy include flexibility of the amounts you can contribute to your plan, a guarantee of no loss in account value regardless of what the stock market is doing, tax-free access to your money for investments or emergencies, liquidity, and gains in account value similar to the stock market. The cash value account inside of life insurance is money that you pay into a permanent policy on top of the cost of the insurance coverage. This money builds on itself with compound interest much higher than any savings account offers. To find out the potential growth of money put into an index strategy, we used what is called an illustration. It shows the different ways cash value builds and other important information. You must be able to put in as much money as allowed in order to get the full growth it can provide. It can earn as much as 15% or more. It can have a steady, guaranteed return of 5% or more if it is a whole life policy. If approved for coverage, The younger you are and the better your health, the better your rates will be. If you are not healthy or of an ideal age to open a policy like this as the insured, you can open it with another person as the insured to keep the cost of the coverage lower, and you can own and control the policy. The person covered must be someone of insurable interest, meaning there must be a meaningful relationship between you and that person to open a policy with that person as the insured. These type of policies can track either one or a combination of the major financial market indicators. These can include the S&P 500, Euro stocks, and Hang Seng indexes. Indexes follow the performance of many large companies. As they make money, your account goes up in value along with them. If and when they lose money, your account is protected from these losses because your money is not actually in the market. It is in an account that benefits from the gains only. This strategy has been used successfully to supercharge savings, helping people take better control of their finances. Being your own bank means you can give yourself a loan and pay the money back to your own account. This lets you pay yourself the interest and compound money for your future instead of paying this interest to a bank. There are administrative fees and costs of insurance for owning a policy like this. However, the advantages here can far outweigh those costs. Passive income versus saving money. One of the single most important keys to financial independence is building passive income streams. Since we only have 24 hours in a day, there is a limited amount of income that can be gained from our daily efforts. Passive income can either be from a business you build, investments you have made, or best yet, a combination of both. With passive income, your work is done up front. Then you are paid over and over again from it with very little additional effort from that point on. This can make up ground for you in what you may be missing from your retirement savings. You might otherwise have much more difficulty getting to your financial goals. You should have at least 3 passive income streams. 7 or more is ideal. This way, if one is interrupted, you will still have the others. This is a true retirement plan because it does not depend on anyone else's ability to pay you. For most, the money from one source of income is barely enough to cover basic expenses. This is why we need several income streams that are passive. There are several ways to begin building passive income. Building any of them will require time, a lot of effort, perseverance, various resources, and advice from people who have done what you want to do. Make a plan and achieve your goals in personal finance. Here is an effective way to accomplish your financial goals. Write down a list of things you want to accomplish in the next 12 months. Then follow these 7 steps. 1. Choose the goal that will have the most impact on your life. 2. Write down that goal as the first one on your list. 3. Write a time at which you aim to have it accomplished. 4. Write down all the things you think of to make that goal a reality. 5. Make those things into a checklist. 6. Make a definite plan around that checklist. 7. Take action by doing something on that list every day. Armed with these tools, strategies, and information, you can put a plan into action. Now, take charge and make your financial goals a reality. If you have any questions or would like to get in touch with us for more information, please visit us on the web at kvrteam.com.